Our market guest tonight says that investors should prepare themselves for volatile and choppy trading for most of the year. He's Jim Lowell, Chief Investment Officer at Advisor Investments. Mr. Lowell, welcome back. I gather you see the possibility, or the likelihood rather, of a pullback on the order of 15 to 20%. So we're either a third of the way through that if you measure by the Dow, or a fifth of the way through it if measuring by the S&P. How quickly do you think this spasm goes by?
Well, it's a great question, Tyler. The surprise so far this year has really been that this has been sort of an unhealthy pullback. It's been very indistinct, very volatile, really reflecting, I think, significant uncertainty as regards not just the equity, but the income market's near-term future. The pullback of a magnitude of 10, 15, maybe as high as 20%, would likely be spurred more by fear of assumptions than by fundamentals. At least that's true currently. We're seeing no fundamental signs of a catalyst for any sort of significant selling. But fear has proven to be a significant factor in terms of both the movement up in the market and in the short-term downdrafts that we've seen. So it wouldn't be surprising.
You know, we've been hearing, Jim, that dreaded word contagion popping up in a lot of market forecasts. You know, what could be the source of any kind of crisis like that out of the emerging markets or something else? Are you looking for any kind of mini crisis out there that will give reasons for the pullback?
Well, we certainly think China is going to deteriorate, maybe perhaps measurably, and that the U.S. markets and the established foreign markets will assume that if China's economy slows more measurably than currently forecast, that will be very bad news for the global markets and likely sell off. But we think that sell-off will be really a knee-jerk reaction to something that we see increasingly more internal to the dynamics of China and less linked to the slow growth, not no growth economy in Europe and the slightly faster paced economic recovery here in the U.S. So if China sells and the markets sell in sympathy, we would view that as a buying opportunity.
You know, I gather you argue for a rather more balanced portfolio for most of your customers, and obviously everybody's different, but if you start with the benchmark, as I think you do, of about 30% in fixed income, that leaves 60 or 70% for equities. So with specific reference to the equity slice of the pie, how do you sliver that between foreign and domestic, between large and small, between growth and value?
Great question, Tyler. The reality is it changes over time. We've made good money in the emerging markets, both in the equity and the debt side of that fence, but we're gone from that pasture for now. Definitely figuring that the U.S. multinational battleship balance sheet blue chips look reasonably valued, if not undervalued by some historic measures, have plenty of cash in the coffers to ride out any sort of tempest in 2014's teapot. We also like Europe. We have been out of Europe in any direct way, really for years upon years, but we began to move back in December. We just stepped up a trade back in to increase our position there. We think Europe is likely to be the bargain of 2014, but you're going to need a good active manager with a proven track record to hold your hand through what could be some pretty difficult times.
Jim, we just have a little bit of time left. You did mention that investors should balance their portfolios with some bonds. What kind of bonds?
Well, surprisingly, of course, the one thing that was supposed to perform the worst this year has been performing the best, 10-year Treasury, total bond funds, or the Barclays aggregate. So we continue to like investment grades, shorter midterm durations, but we also like junk bonds. They're more economically sensitive. In a good, diversified, well-managed fund, you're still getting relative yield advantage, and you're also getting a chicken-hearted way to play the stock market.
I'm a chicken-heart at heart. Jim Lowell, always helpful. Thanks, Chief Investment Officer at Advisor Investments.